Stocks bounce off of a strong opening gap to the downside today. The buy the dip force came in strong immediately from the outset. So we had a strong rally, but by the end of the day, it was interesting to see, what led the way higher on an intraday, and was it enough to really get us back to being bullish again? Was the pullback enough to attract some more a new set of buyers? I'm going to break all that down today in terms of what our posture should be now the rest of this week, with a lot of news coming up. So I'm going to break that all down. I'm also going to break down a trade idea where we start to rotate into a sector that's been a little bit out of favor. It was so expensive in the summer. It's been out of favor the last little bit, and now it seems that investors are starting to slowly move into it as they're running out of momentum in some of these stronger areas. Let's go ahead and get started. Today is Monday, November the 13th, 2017. This is the Market Outlook. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Glad you joined us. What I want you all to do is subscribe to the YouTube channel. Click that red button. Like today's video. Hit that thumbs up right below. Let me know that you found the video useful. One-click feedback for me. Down even further below the video, comment on today's video. Let me know what you learned, something you got out of it today. Also, follow me on Twitter. So you see my Twitter handle on the screen. You'll also see the market forecast tweet pinned to the very top of my timeline. Go ahead and like and retweet today's market forecast tweet if you think that other people should check it out too. We got really close to 100 likes a few days ago, last week. Let's see if we can get over the hump and get the triple digits this week. Alright, I did want to mention here really quickly, on the video, this is Friday's video, you can see down below the video on the YouTube page, in the description, if you click on here, you see where it says show more. Here's the link to join our email newsletter. And then there's the link for the survey. So really quickly, this is what the email newsletter looks like. It has a link to the market forecast for today. You can see multiple links, a summary of what was talked about. These are time-stamped hyperlinks. They get you straight, if you click on these links, get you straight to the segments. And I usually try to summarize what we talk about in those segments too, including the application example here. So these are all hyperlinked that get you to that part of the video. Of course, you can get straight to like the videos on Twitter and on Facebook by clicking on those links. And at the bottom, I post on for the day all the stocks that got bullish and bearish clusters. So here's, and I'm always brainstorming, looking for other things to include in the email. So this won't be the final state. But when you sign up for the email list, this is what you're getting. And you'll also get on Saturdays the email from Brandon about his sector rotation tool that he's built that he'll send out on Saturday. So that's what you get every day when you join the email list. And of course, the survey, again, we're like I said, we're really close to getting our target on this. That link will take you to this survey here. It's got 8 questions, a lot of them just multiple choice. Basically, you telling us, we're interested to know if you would join a company that we create, an investor education company, and then we want to know what you want out of it, because again, we know how frustrating it is for you when an investor education company doesn't take your input or doesn't listen to what you feel is important. So we don't want to go that route. We want to make sure that we create the right product for what you feel like you need. So please let us know. Again, 8 questions. The 8th one here is just kind of our 7th one, is to fill in the blank. That last one, send in your email so that we can be able to to make it right with you. For those who helped us get started, we want to make sure that we do right by you guys and gals. So let us know your name and your email address so that we can keep track of that. Okay, well, let's take a look at the S&P 500 with the market forecast indicator here on the platform, on this trading platform, and see what our expectations are now going forward. You can see we had an update today, a little bit of a bullish engulfing pattern candlestick with today's candle engulfing pretty much the past 2 candles, not quite Thursday's body, but Friday's entire range. We've basically engulfed Friday's entire range there. You can see it brought the near-term line back up. So the near-term line still hasn't crossed below its midpoint. The last time it did, again, was over here in October on that low. 3 days out of 2 out of 3 days down with the engulfing pattern, then the long lower shadow. The buy the dip is strong right now. That force is strong in the markets. I mean, we saw that this morning. The market gapped down and we rallied right almost immediately right off of that. So, again, it's a strong bullish trend. I mean, we've seen this day after day in these charts. There continues to be a strong bullish trend. It's been long in the tooth. I mean, look, the near-term line now has been above 50 12 days, coming off of 20 some odd days here on that rally, and that's coming after a pretty good move over here. So, we're getting a pretty decent rally here. Again, don't be surprised if we don't make another run up to slightly higher highs now. We've had, we talked about having a couple days of pullback, into some Fibonacci support in the range of that long lower shadow. We've had that now. We had it on Friday and then today. Now we're going to bounce. Well, with the near-term line not getting below 50, to add to that the fact that the intermediate posture is now going on 2 months. So we're starting to go over 2 months now of a strong bullish posture. We crossed 50 at the end of August, very beginning of September. So of course 1, 2+ months. So we're almost a 2.5 months here. And then you have market sentiment above 90. So when you throw all that into the equation, we don't expect, you shouldn't expect much higher highs. Now it could skyrocket to the moon for all we know, right? So we can't eliminate any possibilities, but we have to gauge our expectation. We have to gauge how we manage and trade based off what we expect, and now we expect a new near-term move higher, but not too much higher because of the things we just talked about. And if we do get a higher high, with the near-term line not getting above that 94.5 peak here where my cursor is, then that will set up the possibility for a near-term divergence. So that might be in the cards for this week, as long as we kind of meander our ways up slowly, but we meander our ways up to a new all-time closing high again. We're not that far away currently from a new all-time closing high. Take a quick look at the Dow Jones Industrial Average. Very similar pattern, very similar type of engulfing. Its near-term line did drop below 50 on Friday, so we're bouncing up, and again, kind of leads to that potential. Now you notice, it hasn't had the 12-day run, so the Dow had this 1, 2, 3, 4, 5. Let's see, let me count that again. So right here, 1, 2, 3, 4, 5, and then 6 days. And then we had the Friday, and then now we're starting on a new one. So it's a little different than what we're seeing in the S&P. The Dow is, we're getting smaller and smaller after that super long run here, a near-term run. A little bit smaller, might get a little bit smaller again. So another reason to not expect big moves. And then you can see the Nasdaq has not dropped below 50. It did over here, but did not drop below 50 over here either. Still got a strong posture. Still has a very high market sentiment. A lot of these types of stocks are the ones that are influencing the broad market as a whole. And then of course the Russell, which has been pulling back, wasn't very bullish at all today. In fact, another long lower shadow. So that low point still holding, and it held today for support on an intraday basis too, which isn't as important as holding it on the closing basis. But you can see kind of how we're hovering around 38% Fibonacci retracement on this pullback here of this intermediate line. So the intermediate low point here, corresponding to that low, we've had a strong intermediate rally, and now we're pulling back into that 23% Fibonacci retracement. Of course, 1450 is where the 38%. This would be the near-term retracement of that big, long, extended near-term run there. We've been kind of fluctuating highs and low, high and low, high and low, with lower consecutive highs here. And then this is a low near-term low. So now that we're getting a lower high, the potential for a bounce, we're coming up off of a lower low, coming down from what was a lower hot near-term high. So unless we break above 1500, then we're still forming bearish trends, and you see we're below that 6 weeks moving average. So the Russell's still showing some weakness, and if we're going to make another big push to offset this mature intermediate posture and this very mature market sentiment, then this better lead the way higher. Because if it's not, then we're just kind of marking time until this weakness leads into a broader market weakness. The long-term charts, you can see we're kind of peaking here. We're above 100 points difference in the 50 and the 200-day moving averages. We're well up above the 50 to the point now where we typically slow down. As we've seen in the past, we typically slow down and at least kind of let the 50-day moving average catch up to it. So that's kind of the mode we're in right now. And again, we've been this high above the 200-day moving average before, and that's usually where we kind of ran out of gas from a bullish sentiment. So it doesn't mean we have to start tanking, right? I'm hoping I'm making that clear, that the market doesn't have to go up to the moon and it doesn't have to tank either, right? There's obviously a lot of gray area in between, and that's kind of where we're at right now. We're too bullish to tank, but we're too bullish also to keep going up at this pace. So we kind of run out of buyers without any catalyst to bring in the sellers. So we kind of go sideways and let these long-term moving averages catch up, not just here, but on the 30-day moving average too. You see we've caught up to the 30-day moving average, and if you look at the different lines here, we're testing that 17-day moving average. That's kind of the next step in pullbacks, is breaking the 8 and testing the 17-day. Then as these lines get closer, you'll start to get that red arrow. That doesn't necessarily mean that we're dropping. You can get that red arrow and bounce right off of it initially. And that's kind of where we're at. That MACD is slowly grinding down. We're coming down from a higher high. So again, we can definitely get. There's been times where this thing has taken forever to diverge. Here, let me go back to a 2-year chart, where this thing has taken forever to diverge down here, and we get progressively higher highs with lower highs on the actual index itself. After testing that 17-day moving average, you can see we bounced up here, and then we got some broader weakness. Again, wouldn't be surprised if we bounce back up again to maybe another divergence high here. Not enough to bring this up to a new MACD up to a new high, but slow move higher while these lines still grind, maybe get a new all-time closing high, and then looking for some more weakness after that. There's your bullish engulfing pattern on an intraday basis. You see we gap down, way down, gap down below Friday's low point, and then boom, buy the dips. The buy the dippers came out full force right off the bat, and filled that gap just about immediately. But then we kind of got back up to that. There's a gap over here. There's some support resistance at 228 or 258 and a quarter. We were kind of messing around there. Got a little bit up above it, kind of like a fake out type move, and end up closing just above last Friday's high point, in the middle still of last week's range, and down just a smidgen from the 4-week range. I wouldn't put a lot of stock into that because you can see the 4-week range. We're still a lot closer to the top than we are the bottom, and we're still about a week, maybe another 8 days or so from moving. Total days, right? Another 6 trading days from moving this up, this low point up to where we'd move it up quite a bit too, up to right there. So what would that be, 255 and a half? So we're looking at less than 4 points range, and then another day up to 256 and a quarter. Now we're looking at 3-point range here. So if we don't start pushing this up again to new highs, that range is going to get really tight. Even if it just goes up a little bit, it's going to get really tight. And when those ranges get really tight and the MACD has been grinding down close to zero, and that's when you look for the breakdown below the 4-week low point and a more extended bearish run. You can see that if I take a look at the trading range today, and the volume's down below 50 million, the trading range at 1 1/3 point. So if we take a look at 1 1/3 points, it's just above the average right there where my cursor is. The volume at 49 million, that's way down here. So not too bad of a day today. A little bit of volatility in terms of a bigger trading range, but again, it's because we gapped down so much early, and then that volume. If it would have been 80 million with a 1.5 point range, then I'd be a little bit worried, even though it was an up day. But other than that, at least worried about starting that extended pullback now. It doesn't look like we're necessarily there One little red flag is the fact that the MACD the VIX is still high, still above. Haven't really started pulling back down below 11. You can see I got a blue oval there. That is looking at this MACD and the stochastics both below their midpoints and haven't both crossed above it yet. So we're forming a low point right now, which is obviously a lot higher than the last one that we've had, coming down previously from what was a higher high as well. So the trend on volatility is up, and if I go look at the 1 year chart, you can see we've got decent range, and technically we could still get up to about 13 to get a 4-point range for the month, which is kind of on the very low end of typical monthly ranges for volatility. But you can kind of see how it's looking like on a 1 year basis. If I were to take a look at the VIX relative to the 3-month VIX, so kind of that back month 90-day VIX, you can see it hasn't been updated yet for today, but we're getting closer now to that kind of sweet bullish spot. So we get above 90, now we're starting to say, okay, we could be in this for a while. We stay below 90, even if it's up a little bit, which is probably where it's at today. By the time it's all said and done and updated, then we're still fine. We have a near-term pullback, but nothing that we would like liquidate all of our positions for and run for the hills and load up on puts for. All right, so from a major asset standpoint, it was a risk-off day today, at least initially. I mean, of course, crude oil started strong, but you can see it tapered off by the end of the day. International stocks struggled the most. They were down early, along with U.S. stocks, and they finished down. The large cap stocks outperformed the small cap index most of the day. There was a rally at the end. Emerging markets kind of came in, two at the end. Bonds, the dollar, and gold started the day as the three outperforming areas. Crude oil snuck up there too, but all three of those were above stocks for most of the day. Large cap stock finally caught up and finished, all of these around break even, but finished a smidgen above the dollar. But long-term bonds and gold are up there too, and so this kind of and they're all flat, relatively flat. International stocks were a little bit of an outlier to the downside, along with crude oil. But I mean, that's a small move for crude oil, so put that in perspective. This was a flat day. I mean, this is kind of the calm before the storm, so to speak. From an economic calendar standpoint, tomorrow we get PPI, so we'll get inflation data out quite a bit this week. Retail sales, Empire State Manufacturing, Philly Fed, industrial production, the housing market index, housing starts. A lot of retailer like Walmart, Target, I believe, are out this week in terms of earnings. So it's going to be kind of a retail day, kind of the bigger, stronger retailer days at least, week, excuse me. But inflation will be a key. I mean, there's going to be a lot of data points, and right now the odds of a rate hike for December are pretty much close to 100%. And you can see the historical chart. We've gradually, from the beginning of September, we've gradually gone from what was around 30 some odd percent odds of a rate hike by the end of the year, another one, to now close to 100%. And we had pretty decent odds we wouldn't get any more rate hikes, and then that's about when you see the economic surprise index took off. Once that took off, so did this line took off. And at the same time that those took off, in fact, if I were to zoom back out here on this chart and go back out again, I've shown you this before, but just as a reminder, especially for those that are new, if I were to go back out here to that kind of beginning of September area right there, when that economic surprise index started to take off, well, you can see bonds dropped like a rock. So if Fed rate hike expectations took off, bonds dropped like a rock. Gold is down too because the dollar's up. Dollar's been up 4% since that time. Small cap stocks took off. With those interest rate hike expectations, small cap stocks took off too. Crude oil took off, has been up 17% during that time. You can see now large caps are catching up to those gains in small caps, and both of those outpacing international stocks, and of course high yield outpacing treasuries. So I mean that's what the market looks like when we get actually higher interest rate hike expectations. You would think that it would really tank stocks. Right now, rates are so low, it's not a bad thing, because it means, the economic surprise index, it means that things are looking better from an economic standpoint. GDP estimates are above 3% for this last quarter. So, maybe not from a hard data standpoint yet, even though that's starting to look better. A lot of these soft data numbers are looking better. Now, again, like I said, busy week. A lot of hard data this week. Import, export prices, CPI, PPI, retail sales, manufacturing. Now these two, the Empire State and the Philly Fed, they are surveys. They're kind of sentiment surveys in the industry. The industrial production's not. So we'll keep our eyes on that. And of course, housing starts is not, the housing market index is a survey of home builders, but housing starts are actual hard data. So we'll keep our eyes on that this week, and along with some of those major retailers to see how they're impacting. But you can see so far in the week, if I were to zoom back out now and go back to the intraday chart, so far on the week, because we've been so bullish in some of these areas, we're kind of pulling back. You can see, we've been pulling back. There's been a little bit of a theme of risk offness, and we see that today. We saw that today to a small extent because these numbers aren't big over here, but still risk off nonetheless. Not as bullish as we were coming up off these lows, they weren't able to get above to new highs. You can see just looking off the lows here, in fact, just from the open for the S&P, you can see all these equity asset classes really took off. So they took off well, and some of these came down, but again, they didn't take off enough to outpace the gains that some of these other asset classes had early in the day, and so they didn't finish up above them. So risk off. Some bullishness, not really strong bullishness yet, though. You can see on the sector rotation really was a risk-off day. I mean, your small caps, at the beginning of the day, it was consumer staples, utilities, and real estate. All led the way higher. And down here you have healthcare, and you have energy and industrial. So, again, and materials. Those are all economically sensitive areas. Energy, materials, and industrial. So the fact that they're lagging, and of course technology is lagging a little bit, and that's your big momentum player right now. But the fact that those were lagging suggests that, again, a lot of this economic data is not really coming through to these companies, where you want to see some outperformance in these economically sensitive areas. Right now, there's estimates and surveys that says everything should be, peachy keen, but we're not seeing it in the stocks necessarily. In fact, kind of seeing a little bit different story. And again, if I were to go just from the open of the day, so take out the gap at the open and just look at the, again, when stocks took off, well, again, look at what took off. It was utilities, and materials rallied, and financials rallied. So that's a benefit. But you see healthcare there too. So, I mean, it wasn't a total, technology didn't take off. Consumer discretionary didn't really take off and lead the way higher. They were both kind of matching the market. Staples gave up some of those early gains, but not utilities. So interesting to see utilities and materials both kind of the front runners from the low of the day. One of the stocks in that consumer staples area that obviously gets hit hard from a press standpoint is, you can see, Altria Group, Philip Morris, cigarettes, tobacco, one of their main products, has really struggled here in the middle of the year on that FDA announcement. You can see in July when it happened. Brought it back down, but you notice, again, that long lower shadow holds for support. We traded within the range of that long lower shadow, and now we're kind of trending higher and forming higher highs, higher lows. We're getting a new set of 3 green arrows right now off of what would be a higher low point. Phantom green arrow on this stochastic indicator up to potentially new highs. If I take a look here at the Bollinger Bands, you can see kind of breaking out a little bit, a slightly higher close outside that Bollinger Band. Decent volume on this bounce. We don't need a whole lot of volume because we're getting off higher lows, but it's above average. It's almost 1.5 times the average, but definitely above average volume. So again, it's like, okay, and the other thing too, when you look at Philip Morris, it's got an attractive yield again. Its PE ratio, which had been really high when the consumer staples were really overvalued, Philip Morris wasn't looking so good. It wasn't looking so cheap and attractive. And now with this pullback, we had a pullback heading into that, and then the announcement, and then a continued pullback, and we're at the lower end. I mean, again, let me put this move here into a little bit of perspective. So we had dropped well below the 200-day moving average. You can see that we had a divergence in the long-term chart. We got down to $60, which has been a price support. That's where the low got on that day. Had been a long-term support. There's a low point there on the MACD. Finally broke the 50-day, got below the 200. We're back up above the 50. We're making our way back towards that 200. So there's an opportunity here, especially again if there is more of a move to risk off type trades. Not that this is going to go to $100 a share, even though it has made quite the rally here since QE3 ended at the end of 2014, and from that point, $40 to $75, quite the move from a long term. So it's not like we're expecting this to get to $100, especially if there's broader weakness in the broader market. But a lot of that broader weakness most likely will be in that technology area, consumer discretionary, the leaders, right? And it looks like some of these economically sensitive areas too, like materials and industrials. So, if there's going to be any kind of move into here, it's going to be muted because of the any potential broader weakness. But you could look for a move up to that 70, 75 area, kind of a shorter term move. And the other thing too, keep in mind is they did raise the dividend for the stock. So the dividend yield here was over on the trade tab. The dividend yield, keep in mind that's been raised, and so you're going to have a pretty decent yield going forward from here at current levels. And like I said, with a much more attractive PE ratio than what we've seen even earlier in this year. In fact, I think it got back below 20, which again, the CAPE for the broader markets on the 30, and the PEs for everything is just so high. So we finally got some pretty decent levels on this. So kind of one of those long equity potential ideas, but not for a trend, but more for a swing back up to some of that old resistance level. Take advantage, and if it takes a few months, then we'll get a dividend payment out of it. So to summarize, we continue to ride a strong bullish posture and very strong market sentiment. The near-term line has pulled back. In the case of the S&P, not enough. So while we may get a short near-term bounce now, after we expected a couple days of weakness, we've got a couple days of weakness. Well, at least within that range from Thursday's lower shadow. Now there could be the possibility of a slow, smaller move up to a new all-time high, maybe even by the end of this week, but not a convincing new high, but more one that might set up a divergence, especially on like that MACD as we converge down. And so, as we saw today, even though we were bullish, we have safe haven areas leading the way, and today's trade idea kind of says, okay, if we're going to rotate away from momentum into more value areas, then we'll pick one and see if we might be able to make a swing trade out of it. As always, thank you very much for watching the video tonight. I really appreciate the likes. So, we had over a couple hundred likes on the YouTube video. So again, let me know that you found the video useful. Hit that thumbs up down below. Comment down below on any light bulb moments that you had, something you got out of the video tonight. And of course, the survey. We're really getting close to our target on the number of surveys we're looking for, which again, leave your email address, leave your name, so that we can be able to reward you once we get going in our new business venture. But let us know what you think by filling out that survey. Join that email description list. Have a great evening. We'll see you all tomorrow.